Okay, friends, my name is Mool Bhargava and I am today here to explain you about your borrowing capacity. Whenever you want to buy a property or you approach anyone, your first question which comes to your mind is how much can I borrow? So today I am going to explain how much can you really borrow, and I will explain you the concepts. I will explain you the things that what constitutes your borrowing capacity, what increases it, what decreases it, and what factors come to your mind. And if you like this video, you must share it with your friends, your family, and subscribe to my channel. Before I start, I must tell you this is just an educational video. It should not be taken as a credit advice. If you want any specific credit advice, you should approach a licensed mortgage broker like me. You can contact me always. My contact details are given here in this video and at the end of the video, and you are most welcome to contact me anytime you want to. Now let's go to what factor decide your borrowing capacity. First thing first is of course your gross income. That gross income may constitute of your basic income, your casual income, your overtimes, your bonuses, or your rental income. Now the base income is always taken as 100%, while other incomes like your overtimes and bonuses are generally shaded down by the lenders from depending on what policies they adopt for some percentage and then take into account. It forms your normal income, right? So when then we see factors what actually decreases your borrowing capacity. First being of course your living expenses, like your cost for such as rent. Rent is generally not part of it, but sometimes it is considered. Utilities, food, transportation, entertainment, etc. How much you spend on that, and these are, you know, calculated at the level of your family size and your income levels, and then compared with the Australian standards, which are called the HEM expenses. And then we see that if these are matching with those Australian standards, or we need to make some adjustments and have a talk with you and see what is happening. It may also existing debts like your loan payments, your credit card, your balances, and other liabilities also decrease your borrowing capacity. And when we say there, this thing, it is not about how much is the balance, it is about the limits. So what is the loan limit you have? What is the credit card limit you have? In case your credit card limit is say 40,000, your borrowing capacity is calculated as per that. You may be using only 3,000, 4,000, 10,000 a month. But for borrowing capacity purpose, your whole limit is taken into account. So that's why we advise at times that in case you reduce your credit card limits, your borrowing capacity may go up. And the next one, of course, is the interest rate. If the interest rates are higher, your EMI monthly payments go up, and then your borrowing capacity comes down, and vice versa. I will explain to you this now graphically. See, first I will tell you what is added to your income. First is of course your normal income, which I told you. Then are your, the income of your spouse or if any partner is there with you. And then are the rent, if there is some rental income from investment property. And in some cases, there are some family benefits where the children are small and they're getting some benefits from this centering. So these in overall make your total income, which increases your borrowing capacity. And then the expenses. First, of course, household expenses, which reduces your borrowing capacity. The second part is if you any mortgage payments, etc., any loan which you've taken. And then third is, of course, your credit card limits. Then is buffer. What is buffer? I'll explain to you a little later. What is buffer rate of interest? And then what is left after taking out these expenses is called the net surplus. So your new installment from the new loan should be less than the net surplus. That means this is the money which you can use to pay your installment. If it is less than your installment, then you are not eligible for that new loan. You may have to get lesser loan. So this net surplus is important after we have taken care of the buffer rate of interest, which I will explain you soon. Now, it is just an example. Say the buffer rate of interest is the rate of interest which is in addition to the actual rate of interest which you pay. Say for example, the rate of interest is 6%. The banks calculate your probable likely EMI if the rate of interest is 6 plus your buffer rate, that is say 8%, 9%. And they see whether you can still pay your repayments if the interest rate go up by 2% or 3%, whatever the buffer rate is. So that if tomorrow there are increases, in interest rates, you don't feel stressed. You are still able to pay that loan. So that buffer rate is introduced. You actually pay the normal interest. You don't pay the buffer interest. But for calculation of your, stress probability, they add that buffer rate and then see your borrowing capacity. That are you able to pay that? Now, if you want to ask any specific question, this is my detail. You can scan this barcode and you can give me a call anytime. I am always available and I'm always there to help you. Please share it with your friends and subscribe to my channel, and see you in the next video where I will tell you the offset account and redraw facility, how it works and what are the differences in these two facilities. Keep in touch. See you in the next video. Thank you.